These 5 simple changes to your financial strategy could add hundreds of thousands of dollars to your net worth over time. Today, we're diving into the most common wealth-building mistakes I see even the most successful investors make. And they're completely fixable once you know what to look for. So stay tuned, because one of these could be costing you more than your annual salary over the next decade. So for the sake of time, let's dive right into it. Well, welcome back, all you current and existing Wealth Decisions listeners. Every day, I think we have the opportunity to make better decisions around our money and our life. And my goal is to help you do just that. Whether your goal is financial freedom, retiring early, creating a richer life, or becoming a more successful investor, this podcast is just for you. Today, we're talking about 5 fixable mistakes that are quietly eroding your wealth building potential. These aren't complex. They're just fundamental decisions that a lot of people get wrong, leaving some serious money on the table long term. So we're going to explore why Roth 401ks might be sabotaging your tax strategy. We're going to talk about a simple harvesting technique that can save you thousands in taxes every year, and why that bonus check you just spent could have been worth $250,000 by retirement. So let's dive in. Mistake number 1, maxing out Roth 401k contributions without a strategy. I see this mistake constantly. High earners automatically choosing Roth 401k contributions because they think tax-free growth always wins. Now, I am a big believer in having as much money in Roth 401ks or Roth IRAs as possible, but here's what you're missing. If you're in a high tax bracket today, that Roth contribution is costing you a fortune in current taxes. And let me just paint you a picture. Kevin is a software engineer making about $300,000. He contributes $23,000 to his Roth 401k. He's paying taxes on that $23,000 at a marginal rate of 35%. That's about $8,000 in taxes he didn't need to pay this year. Now, if he had chosen a traditional 401k contribution instead, he could have invested that $8,000 in tax savings and likely come out ahead, especially if his retirement tax rate is lower than 35% in retirement. Now, I'm all about Roth 401ks or Roth IRAs, but you need to have a contribution strategy. The Roth versus traditional decision isn't about which account is better. It's about tax arbitrage. You want to defer taxes when you're in high tax brackets and pay taxes when you're in lower tax brackets. So here's my first principle to remember for today. Pay tomorrow's tax rate, not today's tax bracket. If you expect to be in a lower tax bracket in retirement, which many high income earners will be, traditional contributions often win. So here's a strategy and a framework to consider. And it's all based upon what tax bracket you're in. So remember this framework. Under 22, a Roth 401k is all you should do. Between 24 and 32, blend the two. Over 35, pre-tax should be prioritized. This gives you tax diversification and flexibility in retirement. So depending on what tax bracket you're in today, it's not a question of which account is better. It's about tax strategy, paying tomorrow's tax rate, not today's tax bracket. Coming up next, I'll show you how to turn your investment losses into tax savings. And later, why going beyond your employer match might be the smartest money move you're not making. But first, let's talk about harvesting. This is not about having a farm and harvesting crops, but mistake number 2 is ignoring tax loss harvesting. And tax loss harvesting is like finding money in your couch cushions. except the couch is your investment portfolio and the money can be thousands of dollars every year. But most investors completely ignore this strategy. So here's how it works. When you have investments that have lost value, you can sell them to realize the loss for tax purposes. Then immediately buy back a similar but not identical investment to stay in the market. So if you sold a stock that was in the consumer cyclical space, you could buy a consumer cyclical ETF or another consumer cyclical stock for 30 days. And what you're doing here is you're offsetting gains. So when you have those investments that have lost value, you can offset gains elsewhere in your portfolio or reduce your ordinary income up to $3,000 per year with unlimited carry forward. So if you took a $10,000 loss and you didn't do that against gains, you could carry forward that loss not just this year, but for the next couple years. So let me give you a real example. Last year, one of my clients had $15,000 in unrealized losses in their taxable account. And by harvesting these losses, we saved about $3,600 in taxes at the 24% tax bracket. Now, if you invested that $3,600 in savings at a 7% annual return, that $3,600 becomes $14,000 in 20 years. They essentially found $14,000 in future wealth by spending just 30 minutes rebalancing their portfolio. Now imagine if you did that every year and invested that tax savings. Behavioral economist Daniel Kahneman observed that losses loom larger than gains in our psychology. It's always tough to take losses, but in loss harvesting, we flip the script. We use our losses to create gains through tax savings. And the key is to be really systematic about it. Check your taxable accounts quarterly, especially after market downturns. Look for positions that are down 5% or more from your purchase price. Sell them and harvest the loss and immediately buy back a similar fund or wait 31 days to buy back the exact same investment to avoid the wash sale rule. Many people think you need to have huge losses to make this worthwhile, but even small harvesting adds up. So here's my second principle for today. Small losses, big wins. Harvest every season. So we're about halfway through the episode, and if you're already thinking about implementing these first two, you're on the right track. But wait until you hear about the 401k strategy that most people get completely backwards. And the account that's basically a triple tax advantage that 90% of eligible people ignore. So mistake number 3, not going beyond the company match. I have a lot of people, when I ask them, are you maxing out your 401k? And they answer with yes. And then I find out that all they're doing is putting in what they need to put in to get the match. But a lot of people stop at that match. Now, I want you to think about one other thing. A lot of people will maybe go max out an IRA first before they max out their 401k because they maybe have more investment options or they could buy stocks in their IRA. I think this is backwards thinking, especially if you're a higher income earner. And here's why. If you're making good money, you're probably above the IRA deduction limits. That means you're comparing a non-deductible IRA to 401k contributions that do give you a tax deduction. The 401k wins every time, even with limited investment options. Let me just show you the math. Take Jennifer. She earns about $120,000 per year. After getting her match, she puts $6,000 in a non-deductible IRA instead of an additional 401k contribution. That $6,000 IRA contribution gives her zero tax benefit today. But if she put that same $6,000 in her 401k, she'd save about $1,400 in taxes at the 24% tax bracket. And if you invested that savings over 25 years at a 7% return, that tax savings alone becomes over $7,800. But here's what most people don't realize. Most modern 401k plans have perfectly good low-cost index funds. You don't need 47 different investment options. If you're young and just starting out with your 401k, you can put it in one of those life path funds that automatically diversify the portfolio. Or if you want to keep it really simple, all you really need is 4. Get some U.S. total market exposure. Get some international total market exposure. Get some bond exposure if you're a little bit older in your 40s or 50s. And maybe even some type of real estate investment trust fund. If your 401k has these, the expense ratios are usually under 0.20. So you're golden. So my third principle for you today to remember is max the match, then max the tax advantage. Maxing out your 401k is not just about putting the amount in to get your match. Let's go back to Jennifer. If she just put in 5% or $6,000 per year to get her match, she's leaving about $17,000 on the table. That could be put away tax deferred. The current contribution limit to a 401k is $23,000 per year, and that is on top of the match. So if your employer matches 5% and they put in $6,000, that doesn't count towards your $23,000 contribution limit. So the strategy is simple. Get your full match, then contribute enough to your 401k to get you down possibly to the next tax bracket if you're in between tax brackets. Then consider other types of accounts. So we've covered 3 major mistakes, but the next one might be the biggest missed opportunity in personal finance. It's an account that gives you a triple tax advantage that most people either don't know about or they completely underutilize. So mistake number 4 is not maximizing or investing your health savings account. If the 401k is good and the IRA is good, the HSA kind of is the holy grail of tax advantage accounts. It's the only account that gives you a triple tax advantage. You get to deduct the contributions, you get tax-free growth, and you get tax-free withdrawals for qualified expenses. Yet most people treat it like a checking account for medical bills. So here's the HSA strategy that wealth builders use. Contribute the maximum every year. Try to invest it a little bit more aggressively in the beginning and pay current medical expenses out of pocket if you can afford it. Keep those receipts because you can reimburse yourself decades later tax-free. It's like having a stealth retirement account kind of disguised as health insurance. So let me just give you the numbers. In 2025, you can contribute $4,300 for individuals or $8,550 for family coverage, plus an additional $1,000 if you're 55 or older. If you invest that family maximum of $8,550 every year for 20 years at 7%, you're going to have over $350,000, all tax-free if used for medical expenses. But here's the kicker. After age 65, you can withdraw HSA money for any purpose. It just becomes taxable like a traditional IRA. So worst case, it's as good as a 401k. Best case, it's completely tax-free. So to maximize your HSA, first make sure you're eligible by having a high deductible health plan. Second, contribute the maximum each year. And third, invest it in low-cost index funds, not cash. I see a lot of people, they put money in their HSA and it's all in a stable value or cash account. So we're on our final mistake, and this one hits close to home for anyone who's ever received a bonus or an inheritance or any type of windfall. You know, most people, they spend it before they even have it. So mistake number 5 is spending windfalls instead of investing. This is the most emotionally challenging one because a lot of people treat windfalls like found money instead of wealth building opportunities. You know, whether it's a bonus, a tax refund, inheritance, or even just invited $20 in your pocket, The way you handle unexpected money reveals almost everything about your wealth building mindset. There's a lot of different research out there that shows that people treat windfall money differently than earned money. We mentally categorize it as fun money, and we spend it more freely. But mathematically, money doesn't really care where it came from. It only cares what you do with it next. So let me tell you a situation about a client who received a small $25,000 inheritance. He spent $20,000 on a luxury vacation and invested $5,000. His brother invested the entire $25,000, assuming 7% annual returns by retirement in 30 years. Mark's $5,000 became $38,000, but Tom's $25,000 becomes $190,000. That vacation cost Mark about $152,000 in future wealth. Behavioral economist Richard Thaler calls this mental accounting. We create these categories in our mind about money that don't make mathematical sense at all. The antidote is to treat every dollar equally, regardless of its source. I talk about this a lot on my website, in blog posts, and I've talked about this in past episodes. Think about the money you're inheriting or the bonus you're getting, and let's say it's $100,000. Ask yourself how long it would take to save that much money. And if you spent the time it takes to build that amount in your savings account, would you still spend it the same? So here's my windfall strategy. Follow the 50-30-20 rule for large windfalls. Invest 50% immediately. Use 30% for debt reduction if you have any debt that is over 7%. And then use some for emergency fund building. And then allow yourself to spend 20% guilt-free. This satisfies both your rational wealth building brain and your emotional spending brain. And for smaller windfalls under $1,000, I would recommend the double it approach. Match every dollar you spend with a dollar you invest. So if you want to spend that $500 bonus on something fun, if you have the money available, fine. But invest $500 too. So let's wrap up today's episode with an action plan. These 5 mistakes can cost you real money, but they're all completely fixable starting today. So first, review your 401k contributions. If you're in a high tax bracket and you're contributing everything to Roth, consider switching some to traditional. Second, set a quarterly reminder to check your taxable investment accounts for tax loss harvesting opportunities. If you don't have these losses now, you'll be ready when you do. Third, if you're not maximizing an HSA or contributing to one, increase your contribution with your next paycheck. If you don't have an HSA, investigate whether a high deductible health plan makes sense for your situation. And remember our 3 principles from today. Pay tomorrow's tax rate, not today's tax bracket. Small losses, big wins, harvest every season. Max the match, then max the tax advantage. So that's it for today's episode. 5 fixable mistakes to build and keep more of your wealth. Would love if you ordered my new book, Momentous Decisions, 7 Steps to Better Health, More Wealth, and a Richer Life. In the book, you're going to learn how to first adopt a health-conscious mindset. You're going to learn how to avoid some of the common mistakes when trying to create permanent change in your life, health, and wealth habits. You're going to learn how to overcome some of your money and health blocks that are preventing you from reaching your health or financial goals. You're going to learn how to create more meaning in your life. And you're also going to be able to build a stronger identity and belief in yourself. Make change easy at first so that you don't resist making positive, lasting change. You're also going to learn how to set up your environment to give you the best chance to succeed. But probably one of the most important things in the book is identifying and finding your why behind your why. That is what will keep you inspired long term. So if you'd like to order a copy of my book, it's coming out in August. you can go to momentouswealthadvisors.com/book, and you can also read about what some other self-development authors and life coaches and people in the industry are saying about the book. And if you'd like to schedule a discovery call with me, there'll be a link in the description of this podcast. And during a discovery call, I'll take some time to get to know you, find out what's truly important to you, gather some information to see how I might be able to help you reach your long-term financial goals, as well as some of your life goals. So thanks for listening. Please share this podcast with a friend, follow it, share it on social media. My goal with the Wealth Decisions podcast is to reach over 100,000 people in the Twin Cities and beyond so that people can live a richer life. Thanks for listening.